Welcome to the Deep Dive. Today we're breaking down what has to be one of the most watched earnings calls of the quarter. United Natural Foods, Inc., or UNFI, for Q1 fiscal 2026.
Right.
And for the last couple of years, UNFI has really been in a slugfest. They've been recovering from that cyber incident, dealing with all sorts of logistical headaches and fighting this persistent pressure on their balance sheet.
Yeah.
But this quarter, it feels like the whole narrative just flipped. So our mission today is to figure out if this new focus on execution, on pure internal efficiency, is this a real structural change for the company?
Or is it just a temporary win? Exactly. And we're here to untangle this really fascinating split in the results.
The booklet, yeah.
You have a top-line miss, which the market usually hates, but it's set against an absolutely massive profit beat. So how do they pull that off? That's the question we need to answer.
Right, let's jump right into the numbers then, because that's where the story starts.
Yeah.
On the surface, revenue was a little soft. It came in at $7.84 billion, which is, a tiny decline, less than 0.5% year over year.
Yeah.
But it did miss the street's estimate of about $7.91 billion. So that's the cautionary note.
But that miss was completely overshadowed by the profit numbers. I mean, completely. Adjusted EPS soared to 56 cents.
56 cents. And what were analysts expecting? Something like 40.
They were modeling in the range of, 39 to 40 cents. So this isn't just a beat. It's a 40% plus beat. It's a blowout.
And compared to last year, it's what, 250% up?
250%. From 16 cents last year. That kind of leverage, well, you just can't ignore it.
No. And even the GAAP net loss, which, can be a messy number, that improved a lot too, from a $21 million loss a year ago to just $4 million this quarter.
And the market's reaction told you everything. It was instant, it was decisive, and it signaled one thing loud and clear. Right now, investors care far more about margin restoration and operational control than they do about a tiny bit of sales weakness. And the adjusted EBITDA number just confirmed it, surging to $167 million.
Up almost 25%.
Exactly. The story for UNFI right now is not growth, it's optimization.
Okay, so let's unpack that operational strategy. How do you engineer a 250% jump in EPS when, the grocery world is kind of flat and your own sales are slightly down? That feels structural, not lucky.
Oh, it was 100% a conscious strategic choice. It was all about shifting the mix of their business and doing some deliberate pruning.
Pruning.
Yeah, that sales weakness, it wasn't a surprise to them. It was almost all in their conventional segment, which was down almost 12%. And in retail, down about 5.5%.
Which they said was expected.
Totally expected. It was part of the plan to get rid of what they call low accretion business.
Okay, so let's talk about low accretion. We heard a lot about them exiting the Allentown DC. Why is getting rid of a whole distribution center and its customers actually good for the bottom line?
Well, when you talk about low accretion, you're talking about customers or services where the cost to serve them is just way too high for the revenue you get back.
I see.
The Allentown DC was mostly serving these legacy, lower margin, conventional grocery customers. So by walking away from that hub, yes, they took a guaranteed hit to total revenue.
Which is what we saw in the numbers.
Right. But that revenue drop was more than made up for by eliminating the huge logistics and labor costs that went with it. They basically traded a little bit of volume for a lot more profitability.
So the decline in the conventional segment was engineered. Where did the growth come from then?
The natural segment. It was the absolute star of the show. It delivered really strong growth of 10.5%.
Wow.
And that's the proof right there that their big strategic shift, moving towards these higher growth, higher margin channels, it's really starting to pay off.
And they said that was outperforming the broader market, right?
They did. But that actually brings up a really good point of caution here. The natural and organic space is great. It's higher margin, but it's also getting a lot more competitive.
Right. I mean, are the gains UNFI is seeing here sustainable? Or are you going to see the big conventional grocers just keep expanding their own organic brands and kind of eat into that wholesaler premium?
That's the multi-billion-dollar question. And it all comes down to UNFI's ability to partner with retailers that really stand out. Now, their gross margin did improve, up 20 basis points to 13.4%.
It was good.
It's very good. And it was driven by that network optimization and some procurement gains. But, and this is important, the CFO is very clear that they see those procurement gains, special deals and discounts, as temporary.
So the real driver has to be the structural stuff, the optimization.
Exactly. That's the key. And you see it beautifully on the cost side. Their operating expense rate improved to 12.7% of sales.
Down from 12.9. I know it sounds like a tiny move, just 20 basis points,
Yeah.
but on billions in revenue, that's huge.
It's massive. And it shows how tight a grip they have on distribution costs now. In fact, in that conventional business, even with the revenue decline, the EBITDA margin improved by almost 100 basis points.
Wow.
That is just pure, unfiltered network optimization flowing straight to the bottom line.
So let's get into the weeds on that. Let's talk about the physical metrics they use to prove this efficiency story. They mentioned cases handled per hour throughput was up over 2% year over year.
Right. And if you stack that over 2 years, it's up nearly 10%.
In warehousing, a 10% efficiency gain in 2 years? I mean, that's transformative.
It's the ultimate report card on the distribution floor. Think about it this way. For any big logistics operation, a 10% gain means the same building, the same fixed costs, can now handle 10% more stuff. And that throughput gain is the direct result of their lean daily management program. It's now in 34 of their distribution centers, and they're just systematically rooting out waste, one small process change at a time.
And it's not just process, it's tech, too. They called out their AI system, RELX. It's now active in half their network. How does something like that actually change things on the ground?
It gives them surgical precision. It lets them forecast demand for, say, a stable product like cornflakes completely differently than for a niche organic product that might be really volatile.
So better predictions.
Much better. Which leads to 2 huge financial wins. First, fewer stockouts on your popular high-margin items, which boosts sales. And second, less spoilage and waste on specialty items with a short shelf life. It all feeds directly back into healthier margins.
Okay, so that operational story is clean. Let's shift to the balance sheet, because none of this matters if it doesn't improve their financial risk. And the news here was pretty good.
It was very strong. The cash flow performance really stands out.
Yeah, their free cash flow, it was a use of cash, but it improved dramatically. They used $54 million, but that's compared to using $159 million last year.
And they did that while deliberately stocking up on inventory for the holiday season, which is really impressive cash management. And that, combined with the higher EBITDA, let them make real progress on deleveraging. The net leverage ratio came down sequentially to 3.2 times.
And that's a full turn down from this time last year.
A full turn. It's a massive step.
So let's pause on that 3.2 number. For you, the listener, what does hitting that specific ratio actually unlock for a company like UNFI? And why is the target of 2.5 times so important?
Well, in today's world, 3.2 times still keeps them in what you'd call a high beta or high yield category. It's still risky, hitting 2.5. That's the magic number. That's the threshold.
And they reaffirm that target, right? For the end of this fiscal year.
They did. 2.5 times or less by the end of FY26, and then down to 2.0 in FY27. Hitting that 2.5 target basically removes the big red flag that's been hanging over this stock for years. It unlocks better financing terms. It could lead to credit rating upgrades. It changes the story from a company just trying to survive its debt to one that actually has financial capacity.
And they were crystal clear that deleveraging is priority number 1. Ahead of buybacks, ahead of M&A, all of it.
It's a powerful signal of discipline. And it feeds into their whole strategy. They're focusing on this $90 billion addressable market, which isn't the whole grocery market, but it's the part where retailers are trying to stand out.
Right, through services, innovative products, private brands.
Exactly. And speaking of private brands, they highlighted a new push there with new leadership. That feels like really low-hanging fruit for them.
It has to be. Their private brand penetration is below industry levels. It's a clear path to boosting their own margins while also helping their retail partners compete.
It's a total win-win, and it feels like the logical next step now that they're getting the operations in order.
Okay, this is where the market psychology gets really interesting. The stock shot up in the pre-market on this news, but then it faded during the day. It closed up 4.6%, which is great, but it was up like 8% at one point. What does that fade tell you?
That fade is classic skepticism. The initial pop was driven by traders and speculative enthusiasm. You saw it in the volume. It was huge, 2.4 times the daily average.
And the options activity.
Options were 5 times the 30-day average and just massively skewed towards calls. The traders were all in on the upside story.
But the fade suggests the big money, the institutional investors, are still on the sidelines.
That's it, exactly. The analyst consensus is still a cautious hold with an average price target of $37.25.
Which is pretty close to the high of the day, actually.
It was. So the market is still weighing these cyclical grocery pressures against the really strong operational story. It's why UNFI has traded like this high beta special situation stock. The risk flag is still flying, even if it's getting a little dimmer.
So a clear tug of war.
Mm-hmm.
The company is executing, but the market wants to see the balance sheet results fully baked in before it buys the whole story.
That's the tension.
All right, so that brings us to our final segment. If we put on our portfolio manager hats, if we are the investment committee, what's the most aggressive but still plausible trade you can build out of those two facts? The execution and the caution.
Okay. The entire premise here is that the market's $37 price target is fundamentally backward-looking. It fails to price in the acceleration in their deleveraging that we just saw. The market is still pricing in the risk that they might fail to hit that leverage target, not the high probability that they'll succeed.
I agree. If the operations keep this up, the fundamental floor for the stock has to rise, even if revenue is flat.
So the idea is this. You initiate a long-term, out-of-the-money call option position, and you want it to expire in Q4 of fiscal year 2026.
Okay. So you're betting on the timeline they laid out.
It is a pure execution bet. The whole thesis is that if or when management hits that 2.5 times net leverage target by year end, the whole financial narrative changes.
The risk flag comes down.
The primary reason for that sell-side hold rating just evaporates. And when that happens, the stock has to fundamentally re-rate. The story shifts from, repairing a broken balance sheet to a stable platform compounder.
And that shift forces the analysts to upgrade their price targets.
It forces them way beyond $37. And that's what would trigger the option premium. You're betting that the operational engineering will get the balance sheet to the promised land by the end of this fiscal year.
A compelling thesis.
Yeah.
It's built on the idea that operational reality will eventually force a financial revaluation.
That's the trade.
All right, to wrap up this deep dive on UNFI's Q1, an absolutely massive adjusted EPS beat. This was driven by a strategic shift to their natural segment and just rigorous internal efficiency programs.
Yep, lean daily management, the RELX system.
And critically, this execution is flowing directly to their number one goal, getting that debt down.
The margin story is real, and it's driven by that operational engineering. But this raises an important question for you, the listener, to think about. Given that this all comes down to squeezing more efficiency out of their physical network, getting more cases per hour through the door, how much higher can they actually push that throughput?
Is there a ceiling?
Is there a hard physical ceiling with their current infrastructure? And how much does that limit their future profit growth, especially in a world where they can't really rely on price increases?
That is the essential constraint on the long-term thesis. Thank you for joining us for this deep dive. We look forward to analyzing the next set of transcripts with you soon.